I just want to show you the S&P 500 because we're up 6 out of the last 7 trading sessions, and folks, we're getting awfully close there. That old historic high, 29.30, that was back in the end of September 30th, I think. So we are less than 3%. Perhaps from an historic high. Let's not quibble with a few points, but again, 6 of the last 7 days, and it's what you want. Cyclicals that have moved us up. That is what's moving up today. So let's take a look at the charts here. Semiconductors, material stocks, energy stocks, put up sectors there, and you'll see very nicely. And you see banks and utilities and REITs are lagging finally. Take a look at the VIX. We got a 12 handle on the VIX. This is a new low for the year, lowest level since going back to October here. I love looking at Merrill Lynch's fund manager report because I love playing against these guys. So they survey every month about 200 global fund managers. Very useful to see what the thinking is for the big guys, fund managers here, particularly their long and short positions. So they're long cash. Look how defensive everybody is. They're long cash, they're long REITs, utilities, and healthcare. Emerging markets, at least they were right on that. And they're short equities in general. They're short the UK, they're short the euro, and they're short industrial. Okay, so the story here is you want to play against them. So the contrarian signal here is a high cash level means a buy signal for equities. So the contrarian is you long stock versus cash. You're long the European Union, you're short emerging market, and you certainly would go long industrials versus REITs. Their top risks, China's slowdown and the trade war, these have been the top risks for the whole year. You notice what's not on there? The Fed making a policy mistake, or the ECB. These guys believe central banks have their backs, and I completely agree with them. That's the primary mover of this rally that we have seen recently. The most crowded trade they've got, short European equities. Okay, so that's a screaming buy Europe signal right now. Remember, these are generally used as contrarian plays. We'll see if that plays out. They were long FANG. Remember, that was the big trade, most crowded trade a while ago. That eventually blew up in the fourth quarter. FedEx after the close. We want to figure out the global economic slowdown. FedEx, 30% of the revenues outside the United States. Look, here's the bad news. Endless talk about weak global air freight trends. We know all about this. We know all about the post-Chinese New Year trends still being weak. We've heard all about it. That's why I think there's a positive here about low expectations. Take a look at the stock, folks. It got killed in the fourth quarter exactly on what we see here. Down 30% in the fourth quarter. You see a very modest recovery here. That's why I think you could see exact comments there about weak global air freight trends. No surprise, and the stock may not react. Now, again, this is going to be a matter of degree, but a lot of stuff is already very well priced into FedEx. That's why I'm somewhat hopeful. Finally, today, the market is up, and today is the day before the Federal Reserve, and we have the very famous, now infamous, Fed Drift Day. This is the tendency for stocks to rise in the 24 hours leading up to the Fed announcement. It's the day before and going into the announcement at 2:30. This phenomenon was first noted in a very famous 2011 report done by some Federal Reserve researchers. They said it was a puzzle, but it was statistically significant. They studied Fed days going back to 1994. It's been updated recently. The average rise is about 0.5%. And here's the basic conclusion. Since 1994, more than 80% of the equity premium on U.S. stocks has been earned over the 24 hours preceding scheduled FOMC announcement. This is a startling statement when it came out in 2011, but it's since been discussed, dissected. It's now become part of trader law, along with the Santa Claus rally and the January effect. We'll see if that happens today, but again, widely discussed on the street.